Hi, this is Gene Noel. I'm the founder of Gann.com, and my website has been online since 1999. I've been helping traders all along the years in their trading with my Excel spreadsheets and some other formulas that I have and some very simple software that I put together. And not too expensive, I might add. Today we're going to study Trader X. I'm going to show you how it works, what it's for, and how it can help you in your trading and confirming other techniques that you use in your trading. Okay, this is basically the layout of Trader X. If you look to the left side there where the arrows are, you'll see that I have 8 different entries. You start out with the top, and that would be the most recent swing price. It could be either a high or a low, it makes no difference. In this case it was a high, and I'm using a euro. This is an older price. As you can see, the euro 149. That's quite a while back, but it's a very good example of how to use this worksheet here. Okay, so we have 1.4939 was our high, and then the next one was a low of 1.1875. Now you could use either a low or a high to start this off with. However, you have to alternate going back in time 8 different swings. So if you start out with a high, the next one has to be a low, then a high, low, high, etc. If you start out with a low, then the next one has to be a high, low, etc. Okay, once these prices are entered in here, you can see, then we have a series of numbers up in this little blue column right up here. Okay, once you have these numbers here entered into the columns, these prices here are generated. The first price here will be the entry level. In the case of this being a high, this entry level will show you to get short at a certain number right here. By the way, these are the daily charts. I use dailies on this here. You can use hourlies, 4-hour, weeklies, monthlies. It makes no difference. I use this particular worksheet on a daily basis with my 30-minute and my 4-hour bars and my day trading. Okay, so you have the entry price, and you have a trailing stop, and you have a protective stop, and you have a critical price. This little number right here is very important. It's something to watch, and I'll explain that a little bit later. And this being the target price. So after we have reached this high, we're saying that we're going to have a target price of 1.1671, which was a very considerable drop on the euro. But that's a longer term price. That's why the dailies are for use for long term, along with weeklies and monthlies. Right here, this is the market balance price. This was derived by Larry Williams' formula of zero balance. And I asked Larry if I could use it. He had no problem with me putting it in the sheet here. And it's in one of his books. I've read most of Larry's work, and the guy's a master. There's just no question about it. He is the master trader to go by, and I base a lot of my my trading on some of the things that I've learned from Larry. But anyway, the market balance price is derived from the zero balance formula. And what Larry did, he says if he was looking for a 0.8, if he had 7 previous swings, looking for the theoretical 0.8, you would take 0.6 and 0.5, add those two together, and subtract 0.3. Thus 6 plus 5 is 11, minus 3 equals 8. That gives you the theoretical balance. So what I've done here is taken here is point number 6, number 5 right here, and I have subtracted number 3. So that's what these numbers are, and that's how we got this number right here. Okay, that's it. Let's go on to the next slide. The market balance price can be used in several ways. Larry used it in a like a moving average, and he tracked it because he had a lot of mathematical programs and he had a professional mathematician working for him full time at one time. And he did some work on these, and he found out that when this has a moving average and the market moves above it on 2 different times, it'll be a buy, or if the market moves below this on 2 different closes, it would be a sell. And that's some of the work that he did. And this is not always as accurate as we would like. Okay, here's the all-important strength meter. Basically what I've done here is taking the market's overall movements for the past 8 swings, and I have comprised a swing strength based on previous swings. It's really quite complicated, but Paul, Dickey, and myself, the fellow who helped me put this sheet together, we found that when there are certain very wide ranges on swings, that they have a tendency to be followed by a short swing and then another one that's a wide swing after that. So we started doing some work on that, and we put together what we call the strength meter. And it's basically what it's saying is that when this market right here of the 1.4939 high, and when that target is reached, it's going to have a strength of 5 to 2 on the downside. Now you've got capabilities of 4 and 3, 5, 2, 6, 1, and 7, 0. If you have a 7, 0, then we know that we're going to see this market go way below the target price of 1.1617. Okay, going back to the strength meter. So you could have 3 over here and 5, or 2 over here and 5 over here. It makes no difference, but just basically it's going to show you whether the market is going to be weak, or this next push is going to be weak, or it's going to be strong. And this is very, very helpful at times. You'll see what I'm talking about if you ever decide you want to indulge yourself in this worksheet. What I've done here is I have taken the euro dollar on a 4-hour basis. You can use this for 4 hours, 30 minutes, 1-minute charts if you want, and you can use it on weeklies, monthlies, because all the formulas come out and it all balances itself out in the long run. So I use the 4-hour right here. It gives me some targets that are not quite as far out as the other one, and I'll use a 30-minute bar and a 1-hour bar at times for my targets as confirmations. You can see over here, instead of having a target down to 16, we have a target that's realistic at 23.55, which is approximately 3 full points away. And here's your market balance once again of 24.45. Alright, this is a worksheet here that I've done with the charts that from the previous worksheet right here. I've taken this and I put it onto the charts, and this little blue area right in here shows the critical area that we talked about, and this is the critical price, 25.23. Okay, you can see it right in there. And what happened was the market came down off this 26.91 high, and it consolidated at that level. And then once it took that out to the low, you can see the market continued going down. This orange or gold line right here is the target price. And once the market bottomed, I had my other systems working, and this green dotted dash line right here was a breakout number that I used from the bottom, and it told me I want to go long this market at this point right here. So I had all my indicators showing this market was oversold, oversold, oversold. I use my Trader X. I have some other systems that I work with, and if you decide you want to purchase my day trading system, I'll put it all together for you. You can really start making some decent money in this market. Thank you very much. I wish you a good day. I hope this has helped you, And if you have any questions, please feel free to email me anytime at colt@gannline.com. Thank you.